U.S. stock markets are enjoying record highs, and both unemployment and the housing market appear to be stabilizing. So why are some billionaire investors, including some of the most respected in the business, rushing to dump their stocks? Rachelle Akuffo has the story.
Warren Buffett is known as the Oracle of Omaha, a homage to his home in the U.S. state of Nebraska and to his sage investment strategies. His apparent loss of faith in companies that rely heavily on consumer spending could be a telling sign of economic trends. Consumer spending accounts for over 70% of the U.S. economy. Buffett's holding company, Berkshire Hathaway, sold around 19 million shares of Johnson & Johnson and its entire stake in tech giant Intel, reduced his firm's overall stake in consumer product stocks by 21%, and he's not alone. Fellow billionaire John Paulson's hedge fund dumped approximately 14 million shares in JP Chase and its entire position in discount store Family Dollar, as well as consumer goods company Sara Lee. And billionaire George Soros sold off nearly 1 million shares of JP Chase, Citigroup, and Goldman Sachs.
I believe these gentlemen have 3 rules. Number 1 is to always make money. Number 2, never lose money. And rule number 3, don't forget rules 1 and 2. So if you're finding out what they're talking about, it might kind of preclude you that as wise investors are dumping these stocks. There might be a trend to what they're doing.
Many big investors believe companies will spend more money to finance borrowing costs than they will to invest in expansion, a recipe for low profit margins and possible layoffs. More concerns come from economist Robert Wiedemer, one of several analysts predicting the Federal Reserve's $85 billion monthly bond buying program could trigger a massive market correction by as much as 90%, leading to another stock market crash. In 2006, Wiedemer correctly predicted the collapse of the U.S. housing market, equity market, and consumer spending.
As it relates to credit cards, as if credit cards couldn't be high enough, people can be facing 20, 30, even 40% returns, even if you have good credit.
The average person isn't in a position to follow trends set by Wall Street billionaires. But as their trades are bellwethers of what's to come, Main Street investors could once again bear the brunt of another fiscal crisis. Rachelle Akuffo, CCTV, Washington.